Welcome back to another Market IQ video. In this video, we're going to be covering some Forex terminology that you should know. In Forex, it comes with its own set of languages and terms that you guys really need to know if you want to know how to trade, because if we are sitting here talking about, hey, go long, go short, what's your pip, what is your margin, what lot, what leverage, all these terms you'll have to know to be able to understand the Market IQ education and to even chat and talk with other traders out there. So let's dive into it. The first term that we're going to look at is called the cross rate. The cross rate is the currency exchange rate between two currencies, both of which are not official currencies of the country in which the exchange rate quote is given. This phrase is also sometimes referred to as the currency quotes, which do not involve the US dollar regardless of which country the quote is given in. This is the cross rate. Next, we're going to look at the exchange rate. The exchange rate is the value of one currency expressed in terms of another. For example, if Euro USD is 1.3200, 1 euro is worth $1.32 in US currency. The next term we're going to look at is called a pip. A pip is the unit of measurement to express the change in value between two currencies. For example, if Euro USD moves from 1.1050 to 1.1051, that is one pip movement. So knowing what a pip is probably one of the most important things here in Forex and when you're trading in the markets. Just because traders will say, how many pips are you going for? How many pips did you catch? How many pips did you lose? So it's very important that you know what a pip is. Essentially, a pip is just the unit of measurement. So instead of saying distance, it moved 12 feet, we're saying it moved 12 pips. Now, going off of pips, we also have a pipette. So a pipette is a fraction of a pip. So it takes 10 pipettes to make one pip. Now let's dive a little bit more into pips and show you exactly a little bit more on it.
A pip is a measurement of the amount of change in the exchange rate for a currency pair. For currency pairs displayed to 4 decimal places, 1 pip is equal to 0.0001. The exception here is all the yen-based pairs, which are quoted with only 2 decimal places. Nowadays, some brokers offer fractional pips or pipettes to provide extra precision and are displayed as a 5th decimal place. How to calculate your pip value? The value change in quote currency divided by the exchange rate times the amount of units traded is pip value. Let's take a look at this example. The exchange rate for euro dollar is 1.3000. The value change in quote currency 0.0001 divided by the exchange rate 1.3000 times the amount of units traded, for example 1 mini lot, which is 10,000 units, is 0.76 euros. To convert this to your account currency, all you have to do is multiply this with your currency's exchange rate. So, if you're living in USA, all you have to do is multiply 0.76 with 1.3000, which is 0.98 US dollars.
Now we're going to look at the term leverage. Leverage is something that we all use here when trading in the Forex markets, and it's what makes the Forex market so powerful. It's essentially when you're getting kind of like a loan. It's virtual money that you're trading with. It offers you virtual money so you could trade with a higher account balance to make more profits. Now, leverage can get a little bit tricky because yes, you can win more, but you can also lose more. Let's explain more on what leverage exactly is. Leverage is the ability to gear your account up into a position greater than your total account margin. For instance, if a trader has $1,000 of margin in his account and the trader opens a $100,000 position, he leverages his account by 100 times, or 100 to 1, as we like to call it. If the trader opens a $200,000 position with $1,000 of margin in their account, this trader is using 200 leverage, or known as 200 to 1. Increasing your leverage both magnifies your gains and your losses. It's important to know that different brokers that we'll touch on later offer different types of leverage, from 10 to 1, from 50 to 1, to 100 to 1, to up to 500 to 1, and all in between. Now, the more leverage you have, like we said, the more you can win and the more you can lose. Margin is the next term that we are going to cover. Margin is the deposit required to open or maintain a position. Margin can either be free or used. Used margin is the amount in which is being used to maintain an open position, where free margin is the amount available to open new positions. So going off that, with a $1,000 margin balance in your account and a 1% margin requirement to open a new position, you can buy or sell a position with up to $100,000. This allows to traders to be able to leverage their account by 100 to 1. Spread. Spread is the next term that we're going to cover. The spread is the difference between the sell quote and the buy quote, or the bid and the ask. For example, if Euro USD quotes read 1.3200-03, the spread is the difference between 1.3200 and 1.3203, or also known as 3 pips. In order to break even on a trade, a position must move in the direction of the trade by the equal amount to the spread. Here on the screen, you can now see what the spread looks like on an MT4 account. Now, when looking to find a broker, it's very important that you find the lowest spread possibly with a broker. Brokers offer different types of spread. The lower the spread you can possibly get from your broker, the better it's going to be. Now, looking in your NT4 app, let's check out the spreads and what it looks like. So currently, in this screenshot that you're looking at right now, on the XAU USD, or also known as gold, the spread right now is 17. Now here's where it gets a little bit tricky. That is not 17 pips. It's actually, you have to put a decimal in place of it. So it's 1 pip and 7 pipettes. So if it reads 18 in this example right now, it's actually 1 pip and 8 pipettes. In the example now that we're looking at for GU, it is 12, or also 1 pip and 2 pipettes. So what that essentially means is, just for your trade to break even, you have to move up 1 pip and 2 pipettes to break even. So if you're going for a buy, you're entered here with your market order, but you need the price to move up to this just to break even. So you start negative. So whenever you enter a trade, you're always going to start negative. Now let's take a look at some of the major Forex pairs and their nicknames. This is going to be also very important, just because it'll allow you to understand what pairs we're talking about, and if we call it out by its nickname, you'll know exactly what it is. First one we're going to look at is USD. The USD is the US dollar. Euro, or EUR, is the euro. JPY is the Japanese yen. GBP is the Great Britain pound. CHF is the Swiss franc. CAD is the Canadian dollar. AUD is the Australian dollar. NZD is the New Zealand dollar. Now let's take a look at the nicknames of these pairs. If it quotes Euro USD, it's called Euro. If it quotes and looks like Euro If it quotes USD JPY or UJ, it's the dollar yen. If it's GBP USD, it's called cable or sterling. Sometimes we'll also call it GU. USD CHF is the Swissy. The US dollar and Canadian dollar is the dollar Canada or UCAD. And then it's also referred as the loonie. And then AUD USD is the Aussie dollar, also known as AU. NZD USD is the Kiwi or NU. A lot of times we will take the first letter of each pair, and that's what I call it. So GBP JPY is GJ. Gold is just kind of gold. Now let's dive into understanding the Forex currency pair quotes. The exchange rate of two currencies is quoted in what we call a pair, such as Euro USD or USD JPY. Now, the reason of this being is because in the foreign exchange markets, you're transactioning simultaneously while you're buying one currency and selling the other. If you were to buy Euro USD and the euro strengthened against the dollar, you're going to make a profit on that movement. Now, if you bought it and the euro weakened against the dollar, this is where you make a loss. Here on the screen, we can see an example of a Forex quote, Euro versus the US dollar. As you can see, the first currency in the pair that is located to the left of the slash mark is called the base currency. The second currency in the pair located to the right of the slash mark is called the counter, or also quote currency. If you buy Euro USD, the exchange rate tells you how much you need to pay in terms of the quote currency to buy 1 unit of the base currency. In other words, in this example, you have to pay 1.32105 US dollars to buy 1 euro. If you sell Euro USD, the exchange rate tells you how much the quote currency you receive for selling 1 unit of the base currency. In other words, in this example, you will receive 1.32105 US dollars if you sell 1 euro. An easy way to think of this is if you use the base currency as the basis. So if you buy Euro USD, you are buying the euro's currency, the base currency, and selling the US dollar, so which is the quote currency, or also known as counter currency. Going back to the basic point of Forex trading, you're buying and selling currencies based on speculation of whether it's going to go up or go down. That's what we're doing in Forex. So let's take a look at the bid and ask price to kind of go a little bit further into all of this. Bid price. The bid is the price at which the market or your broker will buy a specific currency pair for you. Thus, a bid price. A trader can sell the base currency to their broker. Ask price. The ask price is the price at which the market or your broker will sell a specific currency pair to you. Thus, the ask price, you can buy the base currency from your broker. Bid or bid/ask spread, so also known as spread. A spread is the difference between pips between the bid and the ask price in the currency pair. So looking at this example on the screen, you can see that we have Euro USD. The bid price is 1.36407, and then the ask price is 1.36428. Thus, the difference of those gives you your spread, which is 2.1 pips. Now let's touch basis on some terms that you need to go. We don't always say buy or sell in the Forex markets. We always say long and short. And what we mean by that is when we say buy, we also mean long. When we say long, we also mean buy. So what long means is when we go long, we are buying into the market and we want the market to rise so that we can sell back our position at a higher price than we bought in. So essentially, when we say buy, we mean long. When we say long, we mean buy. This means we are buying the first currency in the pair and selling the second. When you go long, you are buying the first currency in the currency pair. So let's take Euro USD for an example. We buy Euro USD and we want the Euro to strengthen against the US dollar. If the Euro does strengthen against the US dollar, we have turned a profit. We can now sell that position back and we take the profit. Now short. Short also means sell. So if we say sell, think short. If we sell short, if we say short means sell. So if we say short, think sell. When we go short, it means we are selling the market, so we want the market to fall so that we can buy back our position at a lower price than we sold it for. This means if we sell the first currency in the pair, such as Euro USD, and the Euro weakens against the US dollar, we will be in profit. Now let's take a look at order types. Order types aren't always the exact same with a broker, but this is generally what you'll see and what you'll find across the board. So what exactly is a market at order? A market order is at which the order is placed at the current market value and is executed instantly at the best available price. So essentially when you place a market order or just open a new position instantly, instant execution, you're instantly entered into the market. Limit entry order. A limit entry order is placed to either buy below the current market price or sell above the current market price. This gets a little bit tricky to understand at first, so let me explain a little bit more here on. Stop entry order. A stop entry order is placed to buy above the current market price or sell below it. A take profit or TP, this is at a point where we have our trade either hit our take profit or we have a take profit set where when the trade does hit that price in the market, we'll be taken out of the trade. So essentially, if you buy in here and you set a take profit here and the market moves up to here, it'll automatically take you out of that trade and secure profits. This is something that makes the Forex markets so lovely because you don't always have to be looking at your phone or your charts to enter and exit trades. You can place a take profit, and when price hits that, it'll automatically secure profits and take you out of the trade. Now, on the other half, we also have a stop loss or an SL. Now, what a stop loss means is if you place a buy here, you're expecting the market to rise, but if the market actually drops and hits your stop loss, your trade will instantly be taken out, your position will instantly be taken out, meaning it'll cut your losses. So this is something that's also beautiful in Forex is you don't always have to be watching your phone once again. You can place a trade, place a stop loss, run off, go about your day, do whatever you want to do, and if the trade goes the right way and hits your take profit, you'll be taken out of the trade and secure your profits, or it could go down to hit your stop loss and it cuts your losses essentially is all it's doing. You always want to make sure you have a stop loss put in place, just that if the market does come and go the opposite direction that you think it might will, you'll be taken out and you won't blow your entire account.
An order is an instruction from trader to broker that shows the way how trader wants to enter or exit the market. Here are some of the most common types of orders. A market order is an order to buy or sell immediately at the best available price. This type of order guarantees that the order will be executed. Just remember that in a fast-moving market, the price paid or received may be quite different from the last price quoted before the order was entered. A limit order is an order to buy or sell at a specific price. A buy limit is an order to buy at the limit price. This price will always be below current market price. Let's take a look at this example. Trader wants to buy euro dollar, but he's only ready to buy if he can do it more cheaply. A sell limit is an order to sell at the limit price. This price will always be above the current market price. Trader wants to sell, but he's only ready to sell if he can sell at a higher price. A stop loss order is an order to buy or sell once the price reaches a specified price. It is designed for the purpose of preventing additional losses if price goes against you. This is most important order of all. Let's see why. If you bought euro-dollar at the price 1.30 and you were wrong, it happens. Price started to fall. If you had set your stop loss order at 1.2980, your broker would automatically close your position with only 20 pip loss. If you hadn't set your stop loss at all, the price could have just kept falling until you lost all the money that's in your account. You wouldn't want that, right? So always use stop loss orders.
Now let's take a look at lot size and contract size. So in Forex, instead of calling it a contract or buying shares, we look at lots. Lots are like your contracts and your shares, but we say lots. So what is a lot? In Forex, positions are quoted in the terms of lots. The four lot sizes are called a standard, mini, micro, and nano. In the example on the screen, we can see each standard lot, mini lot, micro lot, and nano lot. And you can also see the number of units each one stands for. So a standard lot is 100,000 units. A mini lot is 10,000 units. A micro lot is 1,000 units. A nano lot is 100 units. Now it's important to know you'll hardly ever use and see a nano lot. So what does this all mean? So when using we're going to skip the nano for right now, just because you never really see it, and brokers really don't offer that low. So diving into micro, you'll typically see a micro lot that looks like this. And this is how we're going to calculate how much we make per pip. Now, the US dollar has been fixed. So if the second currency in the currency pair is the US dollar, the price you'll make per pip has been fixed. That fixed number is this exactly. So if you have a micro lot, which looks like this, each pip that it moves, you'll make 10 cents. Now, yes, it reads 0.01, so you would think it's 1 cent, but it's actually 10 cents per pip. So every pip it moves is 10 cents you'll make. So if it moves 5 pips, you made 50 cents. If it moves 10 pips, you made $1. Now it goes up. So now if it's a 0.05, it's 50 cents. So if it's a 0.02, you'll make 20 cents per pip, and so on. The next is where we get into a mini lot. A mini lot is 10,000 units. So with this mini lot, it reads like this, 0.10. It looks like it would be 10 cents, but this is actually $1 per pip. So if your trade moves, if you have a 0.10 lot on your position and your trade moves 10 pips, you just made $10. Now if you do a 0.50, it is $5 per pip. So if your trade moves 5 pips, you made $25 or lost $25. Now if we have a 0.20, it's $2 a pip. So if it moves 2 pips, we just made $4. And then next we're going to jump up to a standard lot. The standard lot is 100,000 units. A standard lot is 100,000 units. So a standard lot reads like this, 1.00. When you place a standard lot, it means you'll make $10 per pip. So every pip you move in the market, the price moves, you make $10. So if it moves 5 pips, you just made $50. If it moves 10 pips, you just made $100. Now let's look at 5.0. So if you have a 5.00 lot, it's $50 per pip. So if it moves 2 pips, you just made $200. Let's show you how to calculate a pip value. Let's assume that we're using a standard lot, which is 100,000 units per lot. Let's take Euro JPY at an exchange rate of 100.50. And what you do is you do a 0.01 divided by 100.50 times 100,000 units, and then it's $9.95 per pip that you'll make. So every pip that it moves, you'll make $9.95. And another example, let's take USD CHF at an exchange rate of 0.9190. Now what we do is we do 0.0001 divided by 0.9190, and we times it by the lot, so 100,000 units, since it's a standard lot in this example. That gives us $10.88 per pip.